What's going on, guys? Hector here. We're going to do a quick trade recap on a trade that I took this week on gold on a 50K funding challenge account that I'm currently trying to pass. And right here, you can see that I made 315 on that account, 50K with Take Profit Trader. Okay, so first thing that I do every single morning, I trade New York session, is I mark out previous session highs and lows. That is London highs and London lows. So doing that right now. That's Asia highs, Asia lows, London lows, and London highs right here, okay? So as we can see, we can remove this level right here. This is London, or I'm sorry, this is Asia lows. London took Asia lows out, okay? We still have Asia highs that haven't been taken out. We have uh, London highs right here, and then we have London lows, but then market, New York pre-market right here, this big engulfing candle to the downside took out London lows, okay? So um, we took our trade right here. We took a buy right here when price reversed. And so the other thing that we like to do is we like to mark out the hourly and 4 hour liquidity because I've mentioned this before. The market moves with liquidity. It has to take out liquidity before it continues in a direction, or if it is going to reverse and continue in that direction to take out more liquidity. Kind of see it like I like this, I like to use the analogy of like a convenience store. Like, say you have a convenience store and you sell sodas and snacks and you sell beer and gum and whatever, right? Like a gas station. Okay, so people go in there and they spend money. The owner receives the money, sells the product, but the owner basically has to reinvest some of that money that he's getting paid to buy more snacks, to buy more Gatorades, to buy more drinks. He can't just pocket all that money because if he pockets all that money and spends it, then the business is going to run out of inventory and it's not going to be able to sell more. So basically, the analogy is so that he could continue to stay in business and continue to grow his profit in that business, he has to reinvest some of that money that he's received and buy more inventory to continue to grow, to continue to write for the business to grow. So same thing with the market. If the market's trending up, whether it's trending up or trending down, it's not going to continue to trend down forever without reversing and taking out some liquidity, right? It's trying to fill orders where people have placed orders and it's trying to fill orders so that it can continue, so it can reverse and then continue to go back in the direction that it was going. So if the market was going up, it's not just going to go up forever like this. It's going to reverse, take out some orders, take out people that bought down here, scare out some retail sellers, and then it's going to take out, right? It's going to take their money, fill some orders, and then continue to push back up. So same thing with the gas station. He can't just pocket all that money. Like, he's not just going to continue to sell products. The products are going to run out. So he has to buy more products. He has to come back down here, buy more products, and then keep reselling them and then keep growing. So it's the same thing with the market. So when I understood this, like, things really flipped and clicked for me. Okay. So we have to understand where hourly and 4 hour liquidity is. Price will always get to hourly and 4 hour liquidity because that's where there's a lot of orders that can be filled that will help the market continue to move in a direction or reverse and switch directions. So, right, we have these two levels that haven't been taken out, which are Asia highs, and I'm gonna leave this right here just for now because this was what we were targeting when we got out, and this is London highs, I believe. Okay, so we have 4 hour liquidity up here, right? This wick right here. I'm sorry, this is the 1 hour chart. So 1 hour liquidity, and then we have 1 hour liquidity down here, and look how price actually came down here, right? Took out this hourly liquidity, right? Took out this hourly liquidity and then reversed and kept going back up. And this is where we caught our trade because price isn't just going to continue to move up and or go into in a single direction without reversing and coming to take out liquidity. Look how there was basically people that had stop losses down here, and the market took them out, filled those orders, and continued to push back up. Okay, so that's exactly what I just explained with the gas station analogy. Okay, so we had that hourly liquidity down there, and then 4 hour liquidity. Let's see if I marked anything up. Yeah, essentially that hourly liquidity is also 4-hour liquidity, and this hourly liquidity is also 4-hour liquidity. And you can continue to mark down here if you like. You can just have those levels marked up if you want. So we'll mark them up just for the sake of marking up liquidity, okay? And so basically we wait for price to get to one of these levels and to take out liquidity, and we're going to see at that level, right? Look how price came, took out that hourly liquidity, and it's also liquidity on the 5-minute where we execute, okay? On the 5-minute chart where we execute, and then it reversed, okay? So what we're doing after this is the second step. So first we mark out liquidity, right? Session highs and lows, and then hourly and 4-hourly levels of liquidity. Secondly, we wait for price to get to one of these levels, and we see if it wants to push through and reach another level of liquidity, right? There's these other levels of liquidity down here and down here, right? Down here, and then all this liquidity down here that we marked up on the hourly and 4-hour. And we wait to see if price wants to take out this liquidity at the level that it reached and reverse and take out more liquidity in that direction, or if it's going to continue to push down in that direction. So we don't guess. We don't guess. Okay, price came down to this level of liquidity. We're gonna just take a gamble and short it and hope that it keeps going down. No, we wait for price to confirm to us that it's going to reject and then keep going to this level before we take that short. Same thing. We're not going to take this buy until we wait for price to hold at this level, break structure to the upside, and hold that level, and then continue to move in that direction. Okay, so we don't guess. We just react to what price does at these levels. So this is exactly what happened right here. New York market open was basically this candle right here. Let me see if I can mark this vertical or something. So we trade basically post New York market open. New York market open was this candle right here. I'll put this vertical candle you see right here is where New York market open, and we can see in pre-market price took out this liquidity, took out this level, okay, took out this level of liquidity, took out all these stops that were down here, and then reversed back up. We had some bullish candles to the upside. We saw price kind of consolidating in this area, and then market open. Price was holding this overall area, and it continued to push up. We basically got in at break of candle. We like getting in at the break of candle after seeing at least a couple nice bullish candles in the or a couple not to because not bullish if we're shorting, but a couple candles, but waiting for a couple candles to close strongly in the direction that we're trying to trade. Um, so waiting for those candles to close and then taking our trade right there and setting our stop somewhere below. Okay, so that's exactly what happened here. Price came, took out this liquidity, consolidated around pre-market. The market opened right here. Remember with this vertical candle, consolidated, that started trending up, and then look at this gap right here. Look at this huge gap. Overall price respected this gap to the upside, and then we took our break of candle right here, and we went and and then this is the second part, because once you actually get in the trade, you don't just want to hold randomly. You want to target levels of liquidity. The market is just taking out other levels of liquidity. This is step 3. So step 1, mark out London and Asia highs and lows, as well as hourly and 4-hourly highs and lows. Secondly, the second step, wait for price to get to one of these levels. Is it going to continue to push past that level to another level of liquidity? Or is it going to hold, reverse, take out that liquidity, and then reverse in the opposite direction, which is what happened here. If it reverses in the opposite direction, or if it continues to go in that same direction, it's continuing to take out more liquidity. So that's what it's doing. That's what price is doing 24/7. It's just taking out liquidity. So we have step 3 right here. Where do we want to exit the trade after we enter the trade? We want to exit at ideally levels of strong liquidity, and we have what we like to call what I like to call equal highs and equal lows. So these are equal highs right here. These are equal highs right here. Okay. Even this one right here. So these are equal highs, okay? This level right here, 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 this level right here. All these are equal highs, meaning they're literally close to each other. They're equally close to each other, right? So this is an easy target for price to come like it did right here. And this is where we got out as soon as we got to those equal highs for price to come to and just take out that market, right? Just take out, there's people that shorted right here, right? There's people that took short positions in this area and they were in profit, right? The smart ones got out when price started reversing. The greedy ones basically let price come all the way back up here and take out their stops, okay? So what did market do after it took out liquidity? It reversed. This is where we took our trade. And then it came and took out these orders that were all right here. All these short stop loss, all these stop loss orders that were right here for people that were shorting the market. Okay. So it came and took out that liquidity. And that's where we got out. Okay. And I want to say this, yeah, this continues to run up and take out major levels of liquidity up here. It got up to these levels up here. Price got all the way up here. Okay, but it doesn't always have to do that. Okay, and as you can see, there's more levels of liquidity all up and down this area, right? Liquidity, 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 liquidity. Okay, so price eventually came up and took out all these levels. We're not going to hold it because we're not that type of swing trader. And price doesn't necessarily have to come take out these levels right away. It can come back down, and we're not willing to do that. Okay, the way we trade is we just kind of scalp slash intraday trade the market. Okay, so that's where we got out right here, and that's basically it. You have to have the exit plan. The exit plan is just as important as the entry. You want to be able to paint a picture, kind of like how I just described. You want to be able to paint a picture of where you think price is going, letting it confirm to you that it wants to go in that direction. Okay, and if it does go in that direction, where exactly is price trying to go and take out liquidity? Are there clear areas where there's liquidity where price wants to fill orders? Yes. If there isn't, then you can't really paint that picture. You're not so sure. So you shouldn't even be in that trade. But that's exactly how we took that trade. And yeah, that's basically it. I appreciate y'all for watching. Subscribe, comment. If you have any questions, put them down below. Take care, guys. Good luck out there.